You know, I've been asked many times throughout my life, what's the difference between a trader and a gambler? And I always say the same thing. The gambler believes in certainty. The trader lives with doubt. Let me tell you something. When I broke the Bank of England in 1992, people called it the trade of the century. They said I made $1 billion in a single day. But here's what they didn't understand. I wasn't certain I would win. I was never certain, and that's exactly why I won. Today, I want to share with you the one thinking pattern that separates people who build wealth from people who lose it. It's not about being smarter. It's not about having more information. It's about how you think about being wrong. By the end of this, you'll understand why the best traders I've ever known were always the most doubtful ones, and why the people who lost everything were always so sure they were right. I started my career in finance in the 1950s. I was a young man who escaped the Holocaust, worked odd jobs in London, and eventually found my way to Wall Street. I didn't come from money. I didn't have connections. What I had was a philosophy degree and a lot of questions. Now, for those of you who aren't familiar with trading, let me explain it simply. Trading is when you buy or sell things like stocks, currencies, or bonds, hoping their price will move in your favor. If you buy a stock for $10 and it goes to $15, you make $5. Sounds simple, right? But here's the problem. Nobody knows for sure which way the price will move. That uncertainty is where everything happens. That's where traders and gamblers split into two completely different worlds. A gambler looks at uncertainty and tries to eliminate it. They convince themselves they know what will happen. They double down when they're losing because they're sure they're right. They treat the market like a roulette wheel where if they just bet big enough, they'll win. A trader looks at uncertainty and embraces it. They assume. They might be wrong. They plan for failure before they plan for success. They build their entire strategy around one simple idea. I don't know what will happen next, so I better be ready for anything. This difference in thinking, this is everything. Let me start with something I developed called the theory of reflexivity. It's a fancy name for a simple idea. People think the market is like the weather, something external that you observe and react to. But that's wrong. The market is made of people, and people's beliefs change the market, which then changes people's beliefs. Here's an example. Let's say everyone believes a company's stock will go up. What happens? People buy the stock, the price goes up. Now more people see the price going up, so they believe it will keep going up. They buy more. The price goes up more. The belief creates the reality, until it doesn't. This is reflexivity. Perception and reality are tangled together, feeding off each other. And here's the key insight. This process always goes too far in both directions. Markets don't find some perfect balance. They swing from extreme optimism to extreme pessimism over and over again. Now, a gambler doesn't understand this. A gambler looks at a rising stock and thinks it's going up because it's good. They believe in the story. They become certain. And certainty is when you start making mistakes. A trader understands that the price isn't truth. It's just what people believe right now, and beliefs can change very quickly. When I shorted the British pound in 1992, I wasn't certain it would work. In fact, I was terrified. I put billions on the line betting that the Bank of England couldn't maintain the pound's value. But what if I was wrong? What if they found a way to defend it? Here's what most people don't know. I didn't just make that bet and walk away. Every single day, I questioned myself. I looked for reasons I might be wrong. I had exit plans ready. I sized my position so that even if I was completely wrong, it wouldn't destroy my fund. That's the thinking pattern. Doubt isn't weakness. Doubt is survival. I've seen so many smart people lose everything because they fell in love with their own ideas. They made a bet and then they needed to be right. Their ego became attached to the position. When the market moved against them, they didn't ask, "What am I missing?" They asked, "When will the market realize I'm right?" That's gambling psychology. That's how you blow up. You want to know the biggest mistake I see people make? They think their job is to predict the future. It's not. Your job is to survive the present. Let me explain what I mean. In 1987, I actually lost a lot of money before the crash. I thought the market was overvalued, so I shorted it. But the market kept going up. I was right about the crash eventually, but I was early. And being early when you're short is the same as being wrong. Here's the lesson. I didn't sit there and say, "The market is stupid. I'm smart. I'll just wait." I cut my losses. I admitted I was wrong about the timing. When the crash finally came, I was in a position to profit from it, but only because I hadn't let my earlier mistake destroy me. Gamblers can't do this. When they're losing, they double down, they average down, they throw good money after bad because admitting they were wrong feels like failure. But in trading, admitting you're wrong quickly is how you succeed. Here's something practical. The way you size your bets reveals whether you're a trader or a gambler. A gambler bets based on conviction. If they're really sure about something, they bet big. If they're less sure, they bet small. Their position size is about how certain they feel. A trader bets based on risk. They ask, "If I'm completely wrong, how much will I lose?" They make sure that amount is something they can afford. They never bet so much that being wrong once destroys them. I've always said, it's not whether you're right or wrong that matters. It's how much money you make when you're right and how much you lose when you're wrong. Think about that. You can be right only 40% of the time and still make a fortune. If you make a lot when you're right and lose a little when you're wrong. But if you bet everything on being right, you only need to be wrong once to lose it all. This is why I could take big positions like the pound trade, not because I was certain, but because I had structured it so that being wrong wouldn't kill me. Here's something that sounds crazy but is absolutely true. The market is always right, even when it's wrong. What do I mean? The market price is reality. It's what people are willing to pay right now. You might think it's too high or too low, but that doesn't matter. The market doesn't care what you think. During the dot-com bubble in the late 1990s, everyone knew technology stocks were overvalued. The fundamentals made no sense. Companies with no profits had billion-dollar valuations, but the market kept going up. A gambler looks at this and says, "This is insane, I'm shorting everything," and they get destroyed because they're fighting reality. They're trying to impose their certainty on an uncertain world. A trader says, "This is crazy, but the market can stay crazy longer than I can stay solvent." They might participate in the bubble, but carefully, they might wait on the sidelines. They adapt to what is, not what should be. The market is a force of nature. You don't fight it, you dance with it. I learned early in my career to love being wrong. That sounds strange, but it's true. When I'm wrong, it means I'm learning something. It means my model of the world was incomplete. That's valuable information. If I can figure out why I was wrong, I become a better trader. Gamblers hate being wrong because they've bet too much. Being wrong means disaster, so they avoid it, deny it, rationalize it away. But I've always kept my bets small enough that being wrong was just data. Oh, I thought this would happen and it didn't. Interesting. Why? What did I miss? Some of my best trades came from being wrong first. I'd make a small bet, lose a little money, learn something, adjust my thinking, and then come back with a better understanding and make a lot. This only works if you're not destroyed by being wrong the first time. That's position sizing again. Let me be honest with you. Emotions are your enemy in trading. Fear, greed, hope, pride, these will destroy you if you let them. A gambler is driven by emotion. They're greedy when things are going well, so they bet more and more. They're fearful when they're losing, but also hopeful, so they hold on too long. Their ego gets involved, and they can't think clearly. I've spent my whole career trying to separate my emotions from my decisions. It's not easy. I'm human. When I'm losing money, I feel bad. When I'm making money, I feel good. But I can't let those feelings make my decisions. Here's a technique I use. I assume I'm always emotionally biased. If I'm excited about a trade, I assume I'm probably overestimating the opportunity. If I'm scared, I assume I'm probably overestimating the risk. I force myself to think from the opposite perspective. What would someone who disagrees with me say? What am I not seeing? Where could I be fooling myself? This self-doubt, this constant questioning, this is the trader's mindset. Markets move in boom-bust cycles. Understanding this pattern is crucial. It starts with a new idea, a new technology, a new market. Early on, a few smart people recognize the opportunity. They invest. It works. The price goes up. Now more people notice. They want in. The price goes up more. Media coverage increases. Everyone's talking about it. Fear of missing out takes over. People who don't understand it start buying just because it's going up. This is the boom. Prices go far beyond any rational value. But here's the thing. During the boom, the high prices seem justified. People create stories to explain why this time is different. Then something breaks. Maybe it's a bad earnings report. Maybe it's a policy change. Maybe it's just exhaustion. The first people to leave are the smart money. Then the momentum reverses. Prices fall. Fear replaces greed. Now everyone rushes for the exit at once. The price collapses. It goes too far in the other direction. Things that are actually valuable become cheap because everyone is terrified. This is the bust. And at the bottom, when everything seems hopeless, that's often the best time to buy. A gambler gets swept up in both phases. They buy at the top because everyone's excited. They sell at the bottom because everyone's panicking. A trader watches this cycle like a scientist. They're skeptical during the boom. They're curious during the bust. They try to profit from the extremes, not participate in them emotionally. Here's an uncomfortable truth. Trading is a zero-sum game, or close to it. For every winner, there's a loser. The money you make comes from someone else's mistake. This is different from running a business, where you can create value and everyone wins. In trading, you're just moving money around. If you buy a stock and it goes up, someone sold it to you too cheap. If you sell a stock and it goes down, someone bought it from you too expensive. So the question is, why would you win instead of them? A gambler doesn't think about this. They just assume they'll be lucky or smart or special somehow. A trader asks, what's my edge? Why do I know something the market doesn't? Or if I don't know more, how can I structure this so that I have an advantage anyway? My edge was often patience and structure. I was willing to wait for extreme situations where I thought the market had gone too far. I was disciplined about risk management when others weren't. I was willing to be wrong small to be right big. You need an edge. If you don't have one, you're just donating money to someone who does. So, here's the core difference, stated simply. A gambler believes they know the future. They bet on their certainty. They're rigid. They're emotionally attached to outcomes. They risk too much. They can't admit mistakes. They eventually blow up. A trader knows they don't know the future. They bet on probabilities. They're flexible. They're emotionally detached from outcomes. They risk carefully. They admit mistakes quickly. They survive and compound their winnings over time. It's not about intelligence. I've known brilliant people who gambled. I've known simple people who traded well. It's about mindset. It's about how you relate to uncertainty. Let me give you the key lessons from everything I've shared. First lesson, embrace uncertainty. Don't try to predict the future with certainty. Instead, prepare for multiple futures. Have plans for if you're right and if you're wrong. Second lesson, manage risk first, seek reward second. Always ask, if I'm wrong, what happens? Make sure the answer is something you can survive. Never bet so much that one mistake destroys you. Third lesson, be willing to be wrong. In fact, expect to be wrong often. The goal isn't to be right all the time. It's to make more when you're right than you lose when you're wrong. Fourth lesson, separate your ego from your positions. Your job isn't to be right. Your job is to make money. Sometimes that means admitting you were wrong and moving on. Fifth lesson, understand reflexivity. Markets aren't rational. They're driven by human emotions and beliefs that feed on themselves. Prices go too high and too low. Your job is to recognize the extremes, not believe the stories. Sixth lesson, control your emotions. Fear and greed will destroy you. Make decisions based on analysis and probability, not on how you feel in the moment. Seventh lesson, think in probabilities, not certainties. A 60% chance of success is good enough if your wins are bigger than your losses. You don't need certainty to make money. You need an edge and discipline. These lessons apply beyond trading. They apply to business, to investing, to life decisions, whenever you face uncertainty. And you always do. Thinking like a trader will serve you better than thinking like a gambler. The world is complex and unpredictable. You can't control it, but you can control how you respond to it. You can stay flexible. You can manage your risks. You can learn from your mistakes. You can survive long enough to benefit from your successes. That's the thinking pattern. That's what separates traders from gamblers. If this changed how you think about risk and uncertainty, I'd appreciate if you'd share it with someone who needs to hear it. Leave a comment telling me what's one belief you're certain about that might be worth questioning. I'm curious to hear your thoughts. And remember, in markets and in life, survival comes first, profits come second. Stay humble, stay flexible, stay in the game. Thank you for listening.